Good afternoon, everybody. It is Wednesday, March 19th. It's FOMC day. We're going to do our prep here ahead of the rate decision and Powell's press conference at 2:30. So that'll kick us off in about an hour. So we have a little bit of time here to get prepared. Just a quick reminder, though, before we do get started, derivatives trading and futures trading is inherently risky, and past performance is not indicative of future returns. Now, with that out of the way, let's take a look at some of the things we reviewed yesterday in our morning prep. So we mentioned that we are not out of the woods yet. We are in this higher volatility regime, and you can see this is also where we get the biggest down moves as well as the biggest up moves on a day-by-day basis. And so yesterday we had that down move. We broke under our rotational low in Globex. We held that as the top. Then we broke under our pivot and went down to our rotational low. So rotational high was the resistance, and then our rotational low held yesterday. And then today we've had a larger move up, but just through our rotational zone again. And we put those levels out earlier this morning. And we are let's take a look here at the insurance. We can go into this. We had mentioned yesterday as well that we're looking for that FOMC to end up in the red. And that is everybody buying that insurance and brings that downward pressure. So we did see that again as well as we look at where we are coming into this. And this typically puts a floor and some kind of support into the market, as we've used this example many times. If you are living on a coast and a hurricane's coming in, if you get the evacuation notice early and you leave and you pack up all of your belongings, the damage isn't going to be as bad. If you choose to stay or wait it out, not have any insurance, not take any protective measures, then that damage can be much worse. So we watch this, and where we look at this is once we get overinsured and there's too much insurance, so everybody's doubled up on policies, then even when the storm hits, it gets dampened. So this tells us right now, when the rate cut comes out and when Powell starts speaking, we are looking, if it goes down, for support to come in as people close out those insurance policies, or initially a big spike to devalue those policies. And then those insurance companies in the market that are selling that those policies will be down. That's where they're collecting all their money. And then after those get closed out, and we'll watch this real time on our end, but after those get closed out, that opens the door for that downside move. And so that's where you see that up move at first in the markets and then the down move coming after. And we saw that on NFP. And we've seen that on FOMC before as well. Last May, it was a really good 100 points up, 100 points down on this exact same kind of structure. As we look a little further out at the beginning of April, we are underinsured. So next week, there aren't as many catalysts to protect against. So that can lead to a more supportive environment. And then the following week, we will look for that to begin to come in again here as well. And if we look at some other indices, gold, again, we are overinsured, and that should be supportive there. The one that doesn't have the insurance on it right now is the Dow. So YM has the potential for more downside than other markets on the FOMC. And we're going to dive into the rates and what we need to pay attention to in terms of levels. But first, again, we'll hit the correlations, as we always want to pay attention to these. And we really want to look at the 2-year, which is inversely correlated to the ES. So we will give out some levels on the 2-year to watch if you're following along, and you can then use that to trade the ES today, as these rates end up moving as traders put on or take off rate cut bets today. The 2-year is always a good proxy for Fed policy, whereas the 10-year is a good proxy for gold and for overall growth. So think of like GDP and economic gravity. The 10-year is further looking, and we'll hit on some things to watch on the 10-year as well. Also, some highlights. The VIX is almost perfectly inversely correlated, meaning every tick up in the VIX, we're seeing the tick down in the ES, so we can watch that. And the yen as well. And this ties into the dollar. The dollar has come down a little bit, but it has been positively correlated. And you can see if we look at the dollar and we go straight across here, the 6E inversely correlated there. Bitcoin is positively correlated. So we're going to talk about that a little bit and the concerns and risks that are posed with those as well. So we want to hit on some of these and how to use them in your own trading and what we're going to look for today. So let's go ahead and we will dive into some of these charts here. First, we're going to start here with the 2-year or the 10-year, apologies. So on the 10-year, if we take off our levels for today, we really can see, and where this plays in is we'll look back to COVID and we're going to look forward. We want to see these in terms of the bonds. What we are looking for is the bonds to eventually rise and the rates, so the yields, to come down. And that's important because if you think back 5 years ago, we had COVID, we had the crash, we had rate cuts, emergency rate cuts by the Fed, and there was a lot of debt refinanced. And now what's coming due is $5 to $7 trillion just from our government, not to mention commercial real estate and business debts that are going to have to get refinanced. And rates are a lot higher now than they were back then. And if you think of where Trump has come from in the current administration, it's a real estate background, golf courses, things that required leveraging of debt. And so if you have to refinance debt on balance sheets for corporations or as wealthy individuals, you want rates to come down. And that begins to start in the next few months. And so this is why we're seeing a lot of this drop in the market, trying to bring it down, trying to drop those rates so that it can be refinanced over duration before starting any more QE and tax cuts and real inflationary measures back into the markets. So we watch this on the 10-year because the 2 years too short term. 10 years a better proxy for this growth. And as the 10-year has risen, the bonds, the rates are coming down, and we're looking for those to continue. So our levels here today that we're going to look for on our trading. Let's zoom in here a little bit. So we're going to watch the rotational low at 110.14 and the rotational highs where we're going to look for any kind of breakout at 110.27. And that is going to signal, again, rates coming down, a slowing of growth, which we've seen in the retail sales that have come in. Consumer sentiment has been dropping, consumer inflation expectations. The rates of change in all of these macroeconomic factors are slowing and saying a disinflation, but also slowing growth. So we're getting inflation to come down, but we're also slowing growth and demand, and that is what brings down the market. If we have slowing inflation, but continuing growth, we end up with stagflation. And if we end up with growth increasing and inflation increasing, then we end up with what happened in 2021, where you had growth and the market going, and inflation was not transitory, as Powell said back then, but the market, made a very large move, as well as in 2023, where we had higher inflation and higher growth, and the market continued to rally. So we pay attention to these on a monthly, quarterly, and yearly basis to understand where the market's going to go. So these are our big levels on the 10-year. We are looking for an eventual breakout over 111 that would signal that we are achieving the goal of bringing down those rates for better refinancing. And that is, again, what we're expecting this current administration to be really trying to push in the end. And if we look here at the ES now, we'll go ahead and get started on our prep here for our main market on the S&P. We are right at our minor line in the sand. This is updating continually for us, but we have that overinsurance in play. And if we hold our minor line in the sand, that is the first sign of support. We are looking for 57.38 to 40 as that first upper rotational level. That we're looking for rotational between 56.50 and 57.40. And if we do get a breakout, we are expecting a higher volatility move today. So a bigger move when Powell does start speaking, an expansion of range. Our upper end and our major line in the sand is up here at 58.42, above our top end of our range right now. which is sitting where we have a $15 billion sell coming in from our systematics. So our systematics are not really participants today. Our market makers, we really need to watch this 38 to 40 area. That is where our big first offer is. And then it's going to be very choppy with the biggest offer before it turns into support at 57.97. We'll just round up and say 5,800, right around our upper pivot. If we stay under this 40 and we get under that line in the sand, then we are looking for much lower, back down to where our market makers will look to be flush with cash and capital to deploy, back down to 55.65. And that is a very important area for us, because that is where we've been bottoming these last few months. We bottomed here back in September of last year. This is the same level that we bottomed there. So we went down August 5th, went up, and then bottomed in September before the rally. Now we're hitting that level again. And if we begin to break this, we are looking for a lower target down in the 5,200s in the coming weeks. If we do happen to break this today, our low end that we're watching is this 5,500, which would be right in here at this 5,480 to 5,500, where our market makers will be fully flush with capital. And again, getting below here, our systematics and algorithmic strategies just begin to dump inventory into the market with 5 billion, 8 billion, and then up to 15 billion in selling coming in and growing each step down, each leg lower. And for those that trade the NQ here, our levels that we want to pay attention to on the NASDAQ are going to be 19,650 and 20,046. And our line in the sand here is at 19,735. So similar to the ES right now, we are over our minor line in the sand, which provides a little bit of dampening. And again, we are overinsured coming into this on the NASDAQ as well. So that should provide some level of support when this data comes out. So that either tells us we're going to watch, and we will use other instruments when we do our own trading. But the initial reaction, if it goes up, we watch for all of that insurance to get covered, all of that to get sold back to the insurance companies, and then that opens up the downside. If we do go down first, again, that's where we see the market find support. You'll have seen this before, where we make a move where it goes down on data, then we go sideways a little bit, kind of chopping around, and then we make the move back up. And that is as people cover that insurance and again sell it back to the insurance providers, then we get the rally coming in. So as everybody's been buying insurance, we've already been making that push up. So all of those policies are losing value as we go along today. So our big thing to watch here on the NASDAQ is going to be this minor line in the sand. Our major line in the sand is where we could start to see the market actually having more than just a bear market bounce. And this could end up having legs and turning a little bit. But staying under this at 20,143 is going to signal again that we are looking at a more of a bear flag and looking lower and a bigger break back down towards 18,700 on the NASDAQ in the coming weeks. And then with the correlations, again, to go back there, is if the 2-year and 10-year start rising, then we would expect the SPX, the NDX, so the cash side of the NQ futures, the dollar and Bitcoin all to start dropping. So that's why we want to pay attention to these yields. And if we go back now to our 2-year yield, similar things are playing out here. So we are stuck in terms of the last few months at between 104 and 102, 102.3. And for today, for our levels that we really want to be watching, so the ones that we can actually bring through correlations for our trading. Again, if we break our rotational low, we are looking for the market to come lower, and then that would send equities higher. Okay, so remember that that inverse correlation here. Holding 103.9.1 is going to send us back up to 103.12, and that's going to send the markets again lower. So these are the two biggest areas, these blue ones that we're going to watch today. If we do start going lower, again, we will watch if we're long in the ES or in the NASDAQ, we would use these levels when the market starts to rally on the equity side. We would use these to see if the uh, bonds start to hold. And if they do, then we can see the top coming in the market. So then that will be what we use to get out of our longs and begin to look short, depending on how that positioning is shaking out. So we want to bring these through because, again, the 2 year is going to matter because this is where traders are going to put rate cut bets. So the 10-year matters on our macro scale and on our longer term interest rates, our debt refinancing. The 2 year matters because that is where Fed policy takes shape and takes hold because it's more immediate. We're looking for inflation over a shorter duration, shorter cycle. So we use the 2 year for this. Now, the one we do want to think about as well here is let's go into commodities for a minute, and then we can go into Bitcoin and the dollar and how those are playing out as well. So on our commodity side, oil, we'll start here, is again stuck in our rotational zone. We can see the position of our market makers with a big offer right here at the 67.90 to 67.40. And that is, again, where we would look for a better short. Is it the 67.60, 67.40? And if we do come down, we're looking at this 65.97. And breaking that will send us much lower on oil. Right now, what this is signaling is there's not much geopolitical risk. When Russia and Ukraine, Israel and Hamas conflict, any global geopolitical conflict, we start to see oil spike. So we can use that for a risk overall. This is saying that there's really no major risk on the global scale. And so we are looking just, again, rotational here for now. If we get over 68, then we look for a much more supportive area. But that's going to be about it on oil. It should be a little cleaner once we get over those. Now, we laid out yesterday and on Monday for our students that copper was going to be the breakout, and we went over this about the Hang Seng and the correlations there after they did quantitative easing. And yesterday, if you took the long at our upper level at that 502, our target here is around 515, but you are up very well with very minimal risk. You could have had yesterday about a 4 to 6 tick stop with about a 50 to 1 risk reward on the swing trade, because we're up about 200 ticks from there, looking for 300 to 400. So, you want to de-risk if you did take that trade and you are long, but hopefully you're following along and capturing some of these as we go, because copper's been a good trade, gold as well. We had longs at 30.32 yesterday, and we've made our push up. Now our upper end is at 30.60, but you can see here from our market maker standpoint, we have a large bid at this 29.84 to 95, and then a large area between this 48 to 37. So if you are buying the dips, which gold is breaking out right now to new all-time highs, we're still watching silver for a break over 35 for its all-time high break. And that also bring in momentum chasers. So remember that for funds and fund performance, they need to show that they're in the right things when they send out the prospectus, and they need to show that they're actually in the growth, and they don't want calls from clients saying, hey, why aren't you in this? Or money leaving their fund. So that's where you get that momentum chasing. And we'll watch for that on silver at that 35, but gold, we saw that on its breakout over that 30.20. And we do have some students in our room that are long either the futures or the options market for that. And so congratulations to those, as it's been a very nice ride lately. But gold, our top end here for today is at 30.60. On our weekly, we're still looking for the 31.03 is the very top end. So that could expand, again, depending on Powell's tone, if it's dovish or not, or hawkish. And probably not a rate cut today, but it's going to be more what the dot plot says and the future of cuts. But remember, cutting rates will devalue the dollar and people will flock towards that safety in gold. So that's what we're going to watch here as more of a hedge against not just inflation, but against disinflation, something that maintains its value and is not is treated more as a currency and not really a commodity, because gold is the standard kind of recognized around the world. So this area here, 48 to 39, if you're buying any dips, this is where you need to watch. If we can actually get over, then we're looking for a much faster, stronger move of 40 to 50 points. And then on to natural gas. It did get up towards that $5 area. We were looking for that on the breakout, and now it has lost its immediate term momentum. So we're watching for that to reclaim at this 424 area. Getting over that, we'll look for 436, and then we can look for a continuation again of this overall trend. Breaking our rotational low here at 406, we will begin in our group to get a little more bearish on natural gas in the immediate term. So that kind of wraps it up there on the commodity end. And let's go to get Bitcoin pulled up here for you. And if we look here at Bitcoin, now, again, let's go back to our correlation table really quick before we dive into this. Bitcoin is positively correlated with the ES, with the NASDAQ, and is pretty close at a 0.87 with the dollar. And again, negatively correlated to our 2 years. So that's why we're going to watch it. But let's think through what this means if Bitcoin and the dollar are positively correlated as we come into this event today. We know that typically, if we think of the SPX and the VIX, so the cash index and the VIX are normally inversely correlated. When the VIX is rising, normally the market's dropping. When the market is rising, the VIX is dropping. That is that inverse relationship. But there is that 20% of the time where you get the SPX up and volatility up. That is a signal of a blow off top. Volatility is just volatility, but when it's on the upside, that is shorts capitulating, that is price chasing, and that normally is signaling a short-term top, kind of that blow off top. So taking that same concept, Bitcoin is a speculative asset, similar to tech. So like NASDAQ is more speculative. That's why it has more beta. It has bigger moves than the ES. Bitcoin is more speculative. You can have 70% drawdowns there, whereas on something like the dollar, you're not going to get 70% drawdowns. The dollar is down about 6% over the last couple of months, whereas Bitcoin is down 20% or more. And we would typically see people, if they're buying Bitcoin, they may be holding dollar reserves, holding cash, because if Bitcoin is very volatile, they want something, one, less volatile, and two, that's more safety, as the dollar has been the standard. Even though the BRICS is trying to change that, we are seeing, the dollar is still the standard across the world, and all oil transactions as well have to happen in the dollar. So that is that flight to safety. And when these are positively correlated, we're thinking similar to what has happened when we see the VIX and the SPX on the same side. So right now, if Bitcoin is rising, the dollar is rising. So we would have people buying speculation, but also buying safety. So you're not going to get as much flow coming into Bitcoin, but that's also showing that there is maybe not as much in terms of legs behind this move. And our rate of change right now on everything, outside of very short term, is all negative. And this bounce that we've had here for the last few weeks or last week or so is looking, one, like a bear flag, but two, is on much less volume than we've had. So these up moves are not happening on any sense of strength. And again, when we want to look at the volume, the strength of the moves, how many people are coming into the market on these, because if you have a store, you want to make sure clients are coming in. If you don't have customers coming in, probably going to go out of business. So when we see these rallies and there is less volume, we are not expecting this to have much legs. And so if we look at our correlations, and if we really start to break under this 81.5 and under 80,003 and really start to break this bear flag, and everything is starting to line up with, again, more slowing in that rate of change, in the speed and the magnitude of these moves. If you're driving up a hill and you stop pressing the gas or the accelerator, eventually you start to roll backwards. And that's what we want to be on guard against, as everything is saying that's what Bitcoin is looking at right now. And back to our correlations, if Bitcoin starts to go and it's 90% correlated to our ES and 92% to the NASDAQ, 87% to the dollar, it's going to pull those down as well. So those are the things we want to watch for on this data release today, is the directionality of these. And then we have our levels that we want to transact at. So we will, the rate cut will come out, or not the rate cut, the rate statement will come out in about 4 minutes. It'll probably have an initial reaction. Really, we want to wait on Powell, because that's what everybody's going to wait on. They'll go through the dot plot, they'll go through the statements, but they'll wait on Powell and his tone and his forecast. And then we'll see the bigger move, and that's when we'll see those insurance plays come off the table. So those are what we're going to watch. In our professional room, we will post updates about every 15 to 30 minutes on where that insurance play stands, just so you guys can follow along. I'll get those out. And then if you have any questions on the levels or anything else, please post them before 2:30. Around 2:20, I will stop responding to anything, as we will be getting ready to put our own positions on deck and get ready for some of these moves. So be sure to be safe trading out there. The only thing that we actually control in the market is our risk. We can have a great system, we can have algorithms, but nothing is 100%. So the only thing we can control is how much we're risking. So make sure you're protecting yourself today. There will be plenty of trades the rest of this week and the rest of this month. Don't lose your accounts today. So have a great day, everybody, and we'll see you again soon.